So potential upside tries to understand what returns the fund can generate over the next 3 years. To calculate a potential upside, we look into what companies are inside the portfolio of the fund and what is the current market price of these companies. We then estimate what will be the earning growth of these companies over the next 3 years, and from this we can calculate what will be the potential upside of the portfolio. In this, we are making a basic assumption that the fund manager would maintain the same portfolio. When a fund has many companies at attractive prices, its potential upside is high. When the companies inside the portfolio tend to rise, then the potential upside may diminish and in some cases completely vanish. Now this is not a bad case on its own, because the fund owners would have seen their returns on their portfolio. Now what would a smart fund manager do? A smart fund manager would sell companies which are high priced but have lower future returns, and buy companies that are low priced but have very high future returns. This would tend to increase the potential returns for the fund, but this takes time. So as an advisor, we tend to advise clients that they should not necessarily be hasty while selling a fund. Thus, a potential upside acts as a good ballpark indicator of when to enter into a fund. However, if a fund tends to reshuffle its portfolio quite substantially, quite frequently, the potential upside can change quite significantly. It makes the understanding future performance of the fund quite tough. Now, we recommend investors to avoid investing in funds which have very high trading activity. They have very high turnover ratios, because it is very hard to estimate what their future returns are likely to be. They tend to be more unpredictable.